What if the numbers you saw on a company's financial sheet weren't just a little off, but flat out, intentionally fudged for a solid 3 years? Hey there, I'm your narrator. For years now, I've been sifting through the nitty-gritty of corporate finance, putting together the real stories that the big headlines tend to skip over. And stick around in this video because you're going to find out how one company, SPAR Group, supposedly pulled off a massive financial scam, the key role of this mysterious figure we're calling the hidden accountant, and a question that'll really make you think. How on earth did their auditor, a huge global firm, miss all of it? For 3 whole years, investors thought they were seeing the real financial picture of SPAR Group Inc. They saw the revenue numbers, the expense reports, the profit margins. But underneath all that, a carefully planned deception was going down. Then, in late 2022 and early 2023, the truth started to crawl out. And it wasn't some quiet reveal, it came in the blunt pronouncements from federal agencies. The U.S. Department of Justice and the Securities and Exchange Commission pulled back the curtain on what they described as an accounting fraud scheme that had been festering inside SPAR Group. The indictment that the DOJ unsealed, it paints a really bleak picture. It alleges that from at least 2016 all the way through 2019, SPAR Group's top executives were actively involved in a deliberate plot to rip off investors. Their whole goal: to mess with the company's financial statements, making SPAR Group look way better off, way more profitable than it actually was. This wasn't just some minor accounting slip-up. No sir, this was a long-haul, multi-year operation. The SEC's own findings back this up, stating in their official order that SPAR Group, along with its former CEO and CFO, messed around with how they recognized revenue and played down their expenses. Source: SEC Edgar Regulatory Report. Just think about what that means for a second. Revenue is the cash coming in, expenses are what you spend. So by jacking up the first part and downplaying the second, they basically created a fake picture of success. Picture a business where sales are artificially pumped up and costs are just hidden or made to look smaller. That's exactly the kind of trickery that can totally warp how a company is really doing. And for all those investors who were counting on those public financial reports, it was a gut-wrenching betrayal. They were putting their money in based on lies. This alleged fraud hit SPAR Group's stock value like a ton of bricks. When a company's reported profits are inflated, its stock price often gets artificially boosted. Investors see what looks like fantastic performance and might jump in to buy shares or hold onto what they have, believing the company is a sure winner. But eventually, when the truth inevitably surfaces, that stock price takes a nosedive. The market corrects itself and all those paper gains just evaporate. And guess what? That's precisely what went down. The very moves made to make the company look strong ended up destroying shareholder value. The SEC stepping in led to settled charges and a hefty fine. SPAR Group ended up agreeing to pay a $2.5 million penalty to settle the SEC's accusations. Source: Global Investigations review this settlement. While a big chunk of change is a very real consequence of the alleged deception, it's the financial cost for allegedly playing fast and loose with financial truths. But the penalty, the fines, that's just what happened after. The real burning question is this: how could this alleged fraud go on for so long, for 3 whole years, without anyone catching on? And that's where the auditor's role comes into sharp focus. Specifically, the failure of that audit process. SPAR Group, just like any other company whose stock is traded publicly, counted on outside auditors to check over its financial statements. These auditors are supposed to be the gatekeepers, the independent folks who verify if the finances are on the up and up. Their whole gig is to make sure the numbers shown to the public are accurate and follow all the accounting rules. And the auditor for SPAR Group during this whole period, none other than BDO, a massive worldwide accounting and advisory firm. A name you hear a lot when it comes to audits, to financial checks and balances. So here's the central and honestly baffling question: how did BDO, a firm with all the resources and expertise to do thorough audits, not catch this alleged 3-year-long accounting fraud? How could the manipulation of revenue and the hiding of expenses just slip by the very professionals who were hired to find exactly these kinds of problems? This isn't about one isolated mistake, not at all. This is about a sustained period where, according to the official filings, SPAR Group's financial health was being deliberately misrepresented. And the auditor, BDO, was in theory giving its stamp of approval to these misrepresented financials year after year. The implications here are huge. If an auditor can miss something this significant and this prolonged, what does that tell us about how reliable audits are in general? What does it mean for investor trust when the supposed guardians of financial truth are allegedly snoozing on the job? To really get a handle on what an auditor is supposed to do, we gotta look at their own words. BDO itself puts out information about how auditing works. They make it clear that auditors are indeed supposed to be on the lookout for fraud. Source: BDO corporate publication. Their professional standards demand that they approach their work with a healthy dose of skepticism and design their audit steps to address the risks of significant errors, whether they're accidental or intentional. This means auditors aren't just going through the motions. They're expected to question management's assumptions, dig into transactions, and gather solid, reliable evidence. When a company is suspected of or is allegedly involved in fraud, the auditor's work should ramp up. They should be actively searching for warning signs, inconsistencies, and any weird patterns. The alleged scheme at SPAR Group involved what we could call the hidden accountant. Now, this isn't one specific person whose name is on the company roster, but more like the role of manipulation being played out by people inside SPAR Group. This hidden accountant was really good at making the numbers look legit. They knew how to cook up fake revenue, how to push back the recording of expenses, how to create the illusion that everything was booming. Think about the specific ways the alleged fraud was carried out: improper revenue recognition and downplaying expenses. Improper revenue recognition can mean recording sales that never actually happened or booking them too early. This might include fake sales, sales where there was no real chance of getting paid, or sales where the buyer hadn't truly taken on the risks and rewards of owning the product. And understating expenses, that's just as deceptive. This could involve treating costs as assets that should have been written off right away, delaying the booking of debts, or just plain not recording expenses at all. When you add all this up over 3 years, the result is a profit picture that's wildly inflated. The DOJ indictment specifically states the scheme was in play from at least 2016 through 2019. Source: Court Records, DOJ press release. That's a pretty significant chunk of time, 3 full fiscal years. Just imagine how many financial statements were put out, how many investor calls took place, how many board meetings were held, all while this alleged deception was happening behind the scenes. And through all of that time, BDO was the company's auditor. They would have been looking at SPAR Group's financial records at least once a year, maybe even more with interim reviews. Their audit reports, which would have been attached to SPAR Group's public filings, essentially acted as a stamp of approval. This brings us right back to the main puzzle. How did the audit process, which is designed precisely to find major errors, fail to uncover this alleged long-term fraud? Was it a lack of critical thinking? Were the audit procedures just not strong enough? Or was the hidden accountant at SPAR Group just too good, too skilled at covering their tracks? The SEC's official order, which states that SPAR Group and its executives improperly recognized revenue and understated expenses, is a super important piece of the puzzle. Source: SEC Edgar Regulatory Report. It tells us what happened in terms of the fraud, but the how of the audit's failure is still a critical part of this whole investigation. Did BDO get tricked? Were they handed fake documents? Or did they just overlook obvious signs of fraud? The official reports don't get into the nitty-gritty details of the audit work BDO actually did or the conversations that happened internally at the firm. We're left to piece things together based on the outcome: a widespread alleged fraud that went on for years. The impact on shareholders is impossible to ignore. When a company's stock price crashes because of revelations about accounting fraud, investors can lose their entire investment. This isn't just about numbers on a screen, it's about people's hard-earned savings, their retirement nest eggs, their financial stability. The trust that people place in public companies and their auditors is absolutely essential for the stock market to function. What the hidden accountant at SPAR Group allegedly did, combined with what appears to be BDO's failure in the audit process, created a perfect storm for deceiving investors. The company looked like it was doing great, its financials seemed solid, all while allegedly hiding a fundamental weakness. This is kind of the paradox of modern corporate finance. On one hand, you've got these super advanced systems and strict auditing rules, but on the other hand, determined people can supposedly find ways around those safeguards. The SPAR Group situation is a really stark reminder that sometimes the drive for profit can lead to the most elaborate and damaging forms of deception out there. The core of our deep dive starts right here, breaking down the alleged 3-year fraud at SPAR Group and tackling that crucial question of how the audit, which is supposed to be a safety net, seemingly failed for such an extended period. What we're going to uncover is a story of alleged manipulation, missed warning signs, and the absolute necessity for openness and accountability in the financial world. The financial statements handed to investors painted a picture of a robust, growing powerhouse. SPAR Group Limited, a global retail marketing firm, projected an image of steady performance. But behind this carefully constructed facade, a darker reality was unfolding. From at least 2016 through 2019, the company's former CEO and CFO were allegedly cooking the books in a sophisticated fraud scheme designed to hoodwink investors about the firm's true health. Source: justice.gov/usosdny/PR/former SPAR Group Limited CEO and CFO charge accounting fraud scheme. Our analysis starts by dissecting the gap between these reported figures and the company's actual operational performance. The core of this alleged fraud involved recognizing revenue improperly and significantly understating expenses. This two-pronged approach created a misleadingly positive narrative, masking underlying financial distress or operational inefficiency. Source Sec Gov litigation admin 2023 3497,864 PDF. How does someone manipulate financial statements to this degree? It's a meticulous process, often involving intricate adjustments and the strategic timing of transactions. The indictment details a scheme where the defendants allegedly engaged in practices that distorted SPAR Group's revenue and expense recognition. This wasn't just a simple error, it was a deliberate effort to defraud investors. Source, Justice, gov/usosdny/pr/ former SPAR Group Limited CEO and CFO charge accounting fraud scheme. To understand the method of concealment, we must map the alleged cross-transactions and shady accounting moves. These involved recognizing revenue from deals that weren't finalized or were totally made up just to juice the top-line numbers. Simultaneously, expenses were deferred, misclassified, or left out of the books to inflate profitability. Each adjustment, though small on its own, built a larger, fabricated financial picture. The SEC's order dives deeper into these accounting tricks. It specifically found that SPAR Group and its former executives improperly recognized revenue. This suggests income was booked before it was actually earned or collectible, a classic tactic in fraud to present a stronger financial position than reality. Source, Sec, Gov/litigation admin 2023 3497,864 PDF. Understating expenses is the other side of the coin. This manifests in various ways, failing to accrue for liabilities, capitalizing expenses that should have been written off immediately, or just not recording costs at all. By minimizing reported expenses, the company's net income appears higher, making it look profitable and sound to investors. Source, Sec, Gov/litigation admin 2023 3497,864 PDF. The complexity of these manipulations raises a critical question. How did they persist for years without detection? This leads us to look at external auditors, specifically BDO, and the evidence pointing toward either negligence or active collaboration. While BDO is a big-name firm, the duration and sophistication of the alleged fraud raise serious concerns about their oversight during that period. Auditors are tasked with providing an independent opinion on whether financial statements are presented fairly. They are expected to follow professional standards and exercise due care. When massive fraud occurs over multiple years, it inevitably prompts harsh scrutiny of the audit process itself. Source, BDO.com/insights/assurance/auditing/what auditors look for in fraud investigations. The question isn't whether auditors can be fooled, but rather, given the circumstances at SPAR, what level of diligence was actually exercised? Were red flags missed? Were audit procedures robust enough to uncover the alleged revenue and expense manipulation? The SEC's settlement with SPAR Group, which included a $2.5 million penalty, highlights the severity of the findings, even as the firm settled without admitting or denying the allegations. Source, Global Investigations Review, com/article/SPAR Group reaches SEC settlement over accounting fraud. To prove negligence or collaboration, we look for evidence of audit failures. This could include failing to identify related party transactions used to inflate revenue or missing the misstatement of expenses. It could also involve a lack of skepticism when presented with unusual or complex entries. The public record, including the DOJ indictment and SEC order, provides the framework for understanding these improprieties. The timeline of internal compliance failures is also vital. A company's internal controls are its first line of defense against fraud. Weak controls, or a culture that overrides them, create an environment ripe for manipulation. The alleged scheme spans several years, suggesting that internal compliance, if it existed at all, was either insufficient or actively circumvented. Examining the chronology of these failures reveals a potential pattern. Were there chances for whistleblowers? Were internal audit reports ignored? The nature of accounting fraud often involves layering transactions, making it difficult to unravel without a deep dive into the company's internal documentation. The SEC's order, by detailing the findings against SPAR Group and its former executives, provides a factual basis for understanding the misconduct. It states that SPAR Group and its former CEO and CFO engaged in an accounting fraud scheme. This scheme involved improper revenue recognition and understated expenses, directly impacting the accuracy of the company's financial reporting. Source, Sec, Gov/litigation/admin 2023 3497,864 PDF. The alleged period of the scheme, from 2016 through 2019, indicates a sustained effort to manipulate results. This duration is significant because it suggests these weren't isolated incidents, but a systemic problem within the company's financial reporting. It also implies that any audit conducted back then should have been particularly sensitive to ongoing irregularities. The DOJ's indictment further corroborates the severity of the allegations, charging the former CEO and CFO with fraud. This legal action underscores the intent to deceive investors. The specific charges suggest the Justice Department believes there is enough evidence to pursue criminal prosecution. Source: Justice, gov/usosdny/pr/ former SPAR Group Limited CEO and CFO charge accounting fraud scheme. Understanding the hidden accountant isn't just about identifying the individuals who committed the fraud. It's about dissecting the intricate methods they used to cover their tracks. This involves a granular look at financial reports versus operational reality, mapping suspicious transactions, and assessing the effectiveness of oversight, both internal and external. The narrative of SPAR Group's alleged fraud is a stark reminder of how financial statements, the bedrock of investor confidence, can be distorted. The techniques used to hide the truth are often complex, requiring a keen eye to unravel. We will continue to explore these methods, bringing to light exactly how SPAR Group's financial reality was obscured from its stakeholders. SPAR Group's settlement with the SEC for $2.5 million signifies a formal acknowledgement of the regulatory findings regarding the fraud. While this resolves the SEC's charges, it doesn't erase the questions surrounding the internal controls and audit procedures that allowed such a scheme to persist for years. Source: Global Investigations Review, com/article/SPAR Group reaches SEC settlement over accounting fraud. The operational reality for SPAR Group during this period, as masked by the fraudulent statements, is a critical area of inquiry. Investors were led to believe in growth, yet the underlying operations may have been struggling. This disconnect is the hallmark of sophisticated financial deception. The mapping of cross-transactions and suspicious accounting is where the true mechanics of the fraud are revealed. These are the specific entries auditors are trained to scrutinize. The alleged failure to address these points to a breakdown in the auditing process, whether due to oversight, weak procedures, or something far more concerning. The evidence of negligence or collaboration by BDO is complex, often determined through forensic accounting and legal proceedings. However, the fact that such a scheme could continue for years under audit raises legitimate questions about the audit's effectiveness and the thoroughness of the procedures employed. Auditors are expected to be vigilant in identifying material misstatements, whether caused by error or fraud. Source: BDO, com/insights/assurance/h. Finally, the chronology of internal compliance failures provides a roadmap of how the fraud took root and flourished. Weaknesses in internal controls, coupled with a lack of accountability, create vulnerabilities that can be exploited. The sustained nature of the alleged scheme suggests a systemic issue rather than isolated incidents within SPAR Group's corporate governance and financial reporting processes. All right, let's get this dialed in and sounding more like us, no more stiff robotic phrasing. We're gonna make this section pop. So the whole shiny front SPAR Group had put up, yeah, it was starting to crack. It wasn't like a sudden explosion, more like this slow, steady squeeze from everyone looking closer. For 3 whole years, they'd been hiding the real mess with fake numbers. But you can't build anything solid on lies, no matter how fancy the foundation looks. Eventually, it's gotta give. What wasn't working became, well, impossible to ignore. Okay, so picture this, it's 2019, right? And this whole alleged scam, which had apparently been going on since at least 2016, was basically like dancing on a tightrope over a huge financial cliff. SPAR Group, led by its old CEO and CFO, is accused of flat-out trying to trick investors. This wasn't some oopsie in the accounting department. It was a planned-out move to mess with the company's financial reports. Source: Justice, gov/usosdny/pr/ former SPAR Group Limited CEO and CFO charge accounting fraud scheme. They were cooking the books, claiming money that wasn't there and pretending expenses didn't exist. Seriously, imagine a company just saying, yep, we're profitable, by just making up income and ignoring what they spent. It's a house of cards, and one good look from an independent auditor could send it all tumbling down. We zoom in on a pile of financial statements, then a little wobble. Now, the folks hired to look through all that deliberately confusing data, the auditors, they weren't exactly buying it. We don't know all the behind-the-scenes drama, but the end result is pretty clear. The Securities and Exchange Commission later confirmed that SPAR Group and those former execs had indeed pulled off this accounting fraud. Source: Sec. Gov/litigation/admin/2023-3497,864 PDF. This tells us there was a key moment when the auditors, using their professional skepticism and smart investigative skills, started spotting the holes. Auditors are trained to spot trouble, weird deals, documents that don't match up, or things that just don't make sense in the industry. When they see a bunch of these signs, especially if it looks intentional, they dig in harder. Source: BDO, com/insights/assurance/auditing/what auditors look for in fraud investigations. So the board, when presented with this evidence, couldn't just look the other way anymore. We zoom into a super tense boardroom scene, you can see the worry on their faces. The stock market, which is basically like a giant mood ring for company health, started to notice. When word gets out about an accounting scandal, even if it's just being looked into, it makes investors nervous. SPAR Group's stock price was pretty much guaranteed to take a hit as people lost faith. And when investors stop believing in a company's numbers, that's a huge deal. They're basically betting their money on the company being honest about how it's doing. If that honesty is questioned, their investment is on the line. It's like a chain reaction. The initial news makes people look closer, leading to more questions and eventually a big drop in how much the company is worth. This wasn't just about SPAR Group's internal mess. It was about how they fit into the whole financial world. A dramatic, heavy musical note hits. The SEC eventually settling with SPAR Group for a hefty $2.5 million really drives home how serious this was. This wasn't some minor slip-up. It was a calculated deception that needed serious government intervention. Source: Global Investigations Review com/article/SPAR Group reaches SEC settlement over accounting fraud. The official order specifically called out wrongly counted revenue and downplayed expenses as the heart of the whole fraud. We see stock tickers crashing down, headlines flashing across the screen. What came out of all these investigations and official actions was a picture of a company with serious ethical problems all the way down. This wasn't the act of one bad apple. The allegations say it was masterminded from the very top, involving the former CEO and CFO. That points to a bigger systemic issue at SPAR Group, where their whole ethical compass was broken. When the folks in charge are the ones messing with the financial reports, it sends a loud message to everyone else: looking good is more important than being honest. That creates a breeding ground for bad behavior hidden behind the power of the leaders. The hidden accountant wasn't just one person, it was the whole company culture of lying buried under layers of fake numbers. A fundamental flaw, not just a one-off mistake. The investigation showed a clear pattern of behavior designed to fool investors and the market. From 2016 to 2019, this alleged scheme was all about making SPAR Group look financially healthy when it wasn't. This wasn't just about making one quarter look good. It was a long-term effort to fake the company's financial situation. Source: Justice, gov/usosdny/com/usosdny/pr/former SPAR Group Limited CEO and CFO charge accounting fraud scheme. And the consequences of this kind of deception are huge. It affects not just the shareholders, but the employees, business partners, and the general trust people have in public companies. The damage from such widespread dishonesty can take years to fix, leaving a permanent mark on the company's reputation and its standing in the market. Alright, let's dive back into that whole SPAR Group mess. Man, it feels like just yesterday the dust was settling, but believe me, the aftershocks, they're still going strong. This isn't some dry, boring accounting tale, nope. It's a really clear picture of what happens when the people in charge of a company just drop the ball on doing things right. We're talking about an alleged scheme running from at least 2016 all the way through 2019, where the former top dog, the CEO and the CFO, they got hit with charges. Why? For messing with the company's financial reports, trying to pull a fast one on the folks who invested their hard-earned cash. Source: DOJ press release. This wasn't some tiny little oopsie either. They supposedly cooked the books by booking revenue they shouldn't have and conveniently forgetting to mention all the expenses, making the company look way better than it actually was. And now the legal hammer is falling, and it's a tough pill to swallow for sure. SPAR Group itself, they've agreed to fork over a cool $2.5 million. That's the penalty they're paying to make peace with the U.S. Securities and Exchange Commission. Source: Global Investigations Review. Now this settlement, it smooths things over with the SEC for now, but it really hammers home just how serious this whole fraud situation was. And it wasn't just the company taking a hit. The individuals calling the shots, they're facing their own consequences too. Getting the former CEO and CFO indicted, that just goes to show when it comes to financial crimes like this, personal accountability is absolutely on the table. We're still waiting on the exact details for the individual sentencing. That's all part of the ongoing legal dance, but the message is crystal clear. You just can't hide behind fake numbers. This whole SPAR situation, it's a giant flashing warning sign for every single company out there. Seriously, the future of how businesses are run, that depends big time on being upfront and honest. Investors, they're putting their faith and their money into those financial reports that companies put out. When that trust gets shattered because of deliberate accounting tricks, the fallout is massive. It's not just the stock price taking a nosedive, it's the public's belief in the whole darn financial system taking a serious blow. The SEC's findings, laying out exactly how they wrongly counted revenue and downplayed expenses, they really paint a vivid picture of just how much deception was going on. Source: SEC Edgar Regulatory Report. So what's the takeaway for you watching this right now? It means you need to demand more. It means we all have to hold these corporations responsible. Seriously, do us a favor and share this report. Get this story out there. Let's all band together and push for companies to be way more transparent and have much stronger rules in place. Your voice, even just a simple share, can help build a financial world where these kinds of lies aren't just found out, but are also met with the full weight of the law. The battle for honesty in the business world. It's a constant one, and we all need to be actively involved.